Hello, this is Rachel live from Kalkine Studios in Sydney and you're watching the early trades. So let's get started. Australian shares did fall sharply this morning following a tumble for US shares. That's as investors balance the prospect of a worsening geopolitical environment with corporate earnings reports released also. The S&P ASX 200 opened 1.6% lower, a shade away from the 1.8% decline for the S&P 500, its American counterpart, which hit its lowest level since June. The fall for Australian blue chips comes as half-year corporate earnings season nears completion, with the likes of Qantas, Blackmores and Ramsay Health among the companies to report before the markets open this morning. A decline for the S&P ASX 200 accelerated in the first 30 minutes of trade, dragging the benchmark 1.9% lower. The tech sector was the worst performer, suffering a 4.3% tumble as previous starlets Life360 and Appen weathered sharp drops after middling earnings and announcements. Life360 was the best performing company within the benchmark last year, but today, their shares tumbled more than a quarter, while Appen shares have shed 17%. 3 in 4 blue chips within the S&P ASX 200 fell after the opening bell, reflecting the broad-based sell-off. The consumer staples sector, a defensive corner of the market, was only one of 11 share market sectors to advance. On that note, let's take a look at some of the newsmakers from this morning. Shares in Life360 shed a quarter of their value in the opening minutes of trade after the company announced its loss had doubled despite growing revenues. The fall was among a handful of powerful swings among the leaders and laggards in the S&P ASX 200 benchmark in the morning minutes of trade, following a busy morning of corporate results being released. Appen has maintained its final dividend despite profit falling by a fifth during the 2021 calendar year. The company's revenue rose 8%, however profit declined 20%. The rise in revenue reflected a strong second half for global services and higher contribution from net markets. Growth in China was also strong, with annual revenue rising by 422%. Appen declared a final dividend of 5.5 cents a share, consistent with a year ago. Insignia Financial, the rebranded entity that comprises IOOF and Wealth Manager MLC, delivered $117.9 million in after-tax profit on revenues of $1.1 billion in the first half of financial year. The company now has funds under management of $98.8 billion and $227 million in funds under administration after a mix of steadily outflows for MLC funds and market appreciation. After-tax profits edged 4% higher for Blackmores as revenues lifted 14% to $346 million in the first half of the financial year, the company reported this morning. They will pay 63 cents ordinary dividend a share on a fully franked basis. After-tax profits for the Cromwell property group fell 9% to $132.5 million for the half year, the company reported, and said it would redouble its focus on its global funds management platform and focus on its global real estate funds management platform in its half-year results report. Third-party funds under management inched higher to $7.8 billion, with most representing European investors. And finally, Service Stream's profit has fallen in the first half of the new financial year. The company's revenue rose 36.7%, while net profit slid 67.1%. Telecommunications revenue rose 11.5%, while utilities revenue climbed 39%. Service Stream didn't declare an interim dividend. Well, that's all for now, but stay tuned for more updates throughout the day. This is Rachel for Kalkine.